All right, let's dive in. We are looking at a stack of paper that is, well, it's quite literally a doorstop. It's over 700 pages, just dense with tables and footnotes and this sort of very legalistic
Yeah,
prose.
it's not exactly beach reading.
Not at all. And it was written in the middle of the Great Depression, ostensibly to teach people how to analyze, of all things, railroad bonds.
It does sound incredibly dry when you pitch it like that.
It sounds like homework, right? But, and this is a massive but, this specific doorstop is widely considered the most important book on finance ever written. We were talking about Security Analysis by Benjamin Graham and David Dodd, specifically the sixth edition.
The Old Testament of value investing, that's what they call it.
Exactly. I mean, this is the book that Warren Buffett, the Oracle of Omaha, calls the absolute bedrock of his entire investment philosophy. He apparently keeps 4 books on his desk.
Right.
2 are first editions of Adam Smith's The Wealth of Nations. One is The Intelligent Investor, which Graham wrote later for, the layman. And the 4th is his original 1934 copy of Security Analysis. He says he's read it at least 4 times.
And that tells you everything. This isn't just a book. It's a mental framework. It's the text that really turned investing from, I don't know, a superstition into a profession. Before this book, Wall Street was essentially a casino operating in the dark.
So our mission today is to figure out why. We need to decode why a textbook written during the worst economic disaster in modern history, filled with examples about companies that don't even exist anymore, is still the roadmap for billionaires like Seth Klarman and Howard Marks today.
Yeah, that's the puzzle.
And we aren't just skimming the summaries here. We are going deep into the mechanics, the mental models of intrinsic value, the margin of safety, the bond math, and crucially, the psychology of the market.
And to do that properly, we really have to start with the atmosphere. You have to understand the smell of the air in 1934. It's critical.
Okay, paint the picture for us. The crash of 29 was 5 years in the rearview mirror by then.
Right. But it wasn't just that the market had crashed. That's almost missing the point. It was that the optimism of the Roaring Twenties had been completely strangled. I mean,
Yeah.
utterly extinguished. In 1929, people genuinely believed stocks only went up. It was a new era.
A permanent plateau of prosperity, I think, was the phrase.
Exactly. By 1934, the prevailing wisdom was the exact opposite. The stock market was a scam. It was a rigged game. The mood wasn't buy the dip. It was survival.
There's a line in the source material that really struck me. It says the general feeling was that financial debacle was the permanent order of things.
The permanent order. Can you imagine that? Imagine a world where everyone believes the economy is permanently broken. That's the context.
Yeah.
Graham and Dodd weren't writing a get-rich-quick guide. Far from it.
Yeah.
They're writing a manual on how to protect your capital from annihilation.
From a total wipeout.
From a total wipeout. They wanted to bring logic, rigorous mathematics, and scientific standards to a field that had just destroyed an entire generation's wealth through tips and rumors.
So if the 1920s were all about speculation and hype, 1934 was about
What?
evidence, reality.
It was about evidence. It was about proving value before you put a single dime down. It was about demanding proof.
Which brings us right to the first major pillar of the book. And it's something they're incredibly pedantic about, the definition of what an investment actually is. They draw this really hard line between investment and speculation.
They absolutely have to, because in the 1920s, everyone thought they were investing, but they were actually speculated with their life savings.
Huh.
So Graham and Dodd dropped this famous dictum, and it's worth hearing every word. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative.
Okay, I want to tear that sentence apart because I feel like modern investors, myself included, we just gloss over it. Let's start with thorough analysis. What does that actually mean to Graham?
This is the hurdle most people trip over immediately. Thorough analysis isn't, I like the product, or my cousin said this crypto is going to the moon. In Graham's world, analysis means a study of the facts in light of established standards of safety and value.
So it's methodical?
It's an audit. You are looking at the capital structure, the earnings history over many years, the asset values on the balance sheet. It is work. It is not a hunch.
Okay, so it's work. Then we get to safety of principal. Now, be honest. Is safety of principal actually possible in the stock market? Stocks go down all the time.
That's a great pushback, and it's a common one. Graham and Dodd are careful here. They don't mean absolute safety. If the U.S. government collapses or a meteor hits New York, nothing is safe. That's not what they mean.
Right.
They mean protection against loss under normal or reasonably likely conditions. It's about building in a buffer against the predictable storms, not the once-in-a-millennium cataclysms.
So it's about probability. It's about structural integrity.
It's about structural safety. That's the perfect phrase. If you buy a bond backed by a factory worth $10 million and the bond is only for $2 million, you have safety of principal. Even if the company goes bankrupt, the factory can be sold to pay you back. That is structural safety.
But I buy a hot tech stock trading at 50 times earnings because I hope it goes to 100 times earnings.
You have zero structural safety. You are relying entirely on the next person paying more than you did. You're relying on market sentiment.
And the third part, satisfactory return. I find it interesting they don't say maximizing return or highest possible return.
No, they don't. And that's absolutely crucial. Satisfactory can be income, like interest or dividends, or it can be capital appreciation. But the key is that the return must be satisfactory to the intelligent investor. If you are demanding 100% returns in a week, you are forced to leave the realm of safety. You're forced to speculate.
So just to be crystal clear, anything that doesn't meet all three of those criteria, analysis, safety, and a satisfactory return, is by definition speculation.
Yes, and Graham isn't some kind of prude about it. He admits speculation is necessary. It has a place. I mean, someone has to take the risks on new technologies, on new ventures.
Sure.
But he distinguishes between intelligent speculation and unintelligent speculation. And that's where most people get into trouble.
Let me guess. Unintelligent speculation is what I do on my phone at 2 in the morning after reading a Reddit thread.
Very likely. Unintelligent speculation is taking risks without any real study. It's speculating when you think you were investing. That's the most dangerous kind. Or it's speculating with money you genuinely can't afford to lose.
So what's intelligent speculation?
Intelligent speculation is like being a professional poker player, or maybe even a casino owner. You know the odds are tight. You know there's a real chance of loss. But you've calculated that the potential upside justifies the risk you're taking. You've weighed the pros and cons.
The text uses a casino analogy for this, specifically with roulette.
Right. The untrained investor is the roulette player. The odds are mathematically against him. The house has an edge, say 19 to 18. If he plays long enough, he will lose. It's a mathematical certainty.
And the security analyst?
The analyst tries to reverse those odds. Through deep research, they try to find situations where the odds are 18 to 19 in their favor. They're trying to become the house.
Seth Klarman's essay in the new edition of the book really hammers this point home. He mentions that today the word investment is used for, well, for everything. Art, wine, rare stamps, NFTs.
It's what he calls asset class creep. Klarman points out that if you buy a painting, it produces nothing. It has no cash flow, it has no earnings, it can't grow or innovate. Its value is entirely dependent on what he calls buyer whim.
On someone else wanting it more than you do later?
Precisely. Graham would say that's pure speculation. You are betting that tastes will change in your favor. An investment, in the Graham sense, usually implies an underlying business or asset that generates wealth on its own, independent of public opinion.
Okay, so if I buy a farm, that's an investment because it grows corn and the corn has value.
Yes.
But if I buy a Picasso, that's speculation because it just sits on the wall until I can convince someone else to buy it for a higher price.
You've nailed it. The farm has intrinsic value. The Picasso only has a market price.
And that is the perfect segue to the second massive foundational concept of this entire book. Intrinsic value. This is the engine of the whole thing, isn't it?
It absolutely is. The central tenet of all value investing is that price and value are two different things. They're rarely the same. Price is what you pay. Value is what you get.
But this is where people, myself included, get stuck. How do you actually calculate intrinsic value? Is there a magic formula in the book that says, assets divided by earnings times pi equals value?
I wish. It would make life a lot easier. But no, Graham and Dodd are very, very clear on this point. Intrinsic value is an elusive concept. It is not a specific number. You cannot look at a company and say, this share is worth exactly $42.50.
So it's fuzzy. It's an art, not a science.
It's a range. It's an approximation. They use a fantastic analogy in the book. Imagine you're looking at a person across the room. You don't need to know their exact weight in pounds and ounces to know if they're overweight.
Right. If a guy's 400 pounds, I don't need a scale to tell me he's heavy. The conclusion is obvious.
Exactly. And you don't need to know a woman's exact birth date to know she's old enough to vote. In investing, you are looking for those same obvious discrepancies. You don't need to know if the intrinsic value of a stock is $80 or $90. You just need to know that it is definitely worth substantially more than the $40 it is selling for today.
Okay, let's make this concrete. Let's look at a real example from the book because the JI Case Company study from 1933 is just mind-blowing. It really illustrates the point.
This is the classic net-net example. It's almost unbelievable by today's standards.
Okay, so walk us through the math. We're in 1933, the depths of the Depression.
So J.I. Case is a major farm equipment manufacturer. The stock price has completely collapsed. It's trading at $30 a share.
$30, got it.
Now, Graham gets the company's annual report and looks at the balance sheet. And here's the key. He ignores the factories, the brand name, the patents. He treats all that long-term stuff as worth zero, just for safety's sake.
Okay.
He just looks at the current assets. That's the cash in the bank, the accounts receivable that are about to be paid, the inventory of tractors in the warehouse, the liquid stuff.
Stuff you could sell off pretty quickly.
Right. And from that number, he subtracts all the debt, every single time the company owes to anyone. The value that's left over, what he called the net current asset value, was $176 per share.
Hang on, wait a second. The stock is trading at $30. And the easily sellable cash equivalent value, after paying off all debts, is $176.
Correct.
That's like buying a wallet with $176 inside it for a price of $30. How is that even possible? Was the market just broken?
The market was a voting machine, as Graham would say. People were so terrified of the Depression and the Dust Bowl that they assumed J.I. Case would never sell another tractor again. They assumed the company would just bleed cash until it died.
But Graham looked at the weighing machine.
He looked at the hard facts, he saw the substance. He also looked at the history and saw that over the last 10 years, the company had averaged earnings of $9.50 a share. Even in a depression, a company with $176 of liquid assets per share isn't going to go to zero overnight.
The discrepancy was just enormous.
It was so massive that you didn't need a complex financial model. You didn't need to guess about next year's earnings. The value was screaming at you from the balance sheet.
You just needed the guts to buy it when everyone else thought you were insane.
Correct. And that discrepancy, that gap between price and value, leads us directly to the concept that protects you when the math isn't quite that obvious: the margin of safety.
This is the secret sauce, the buffer.
It's the single most important concept in the book. It's the engineering principle applied to finance. If you build a bridge that can hold 10,000 pounds, you post a sign saying maximum load, 5,000 pounds.
You don't drive a 9,999-pound truck across it.
Of course not, because engineers know that steel can have microscopic flaws, or the wind might blow harder than expected, or the calculations might be slightly off. You need a buffer for error.
For the unknown unknowns.
Exactly. In investing, the data is often flawed. The future is always uncertain. Management might be overly optimistic or even lying. The margin of safety is the discount you demand from the intrinsic value to absorb all those errors, all that bad luck, and all the vicissitudes of the economy, as Graham puts it.
So if you think a stock is worth $100 and you pay $95, you have basically no margin of safety. If you're wrong by just 10%, you lose money.
Right. But if you calculate the value as 100 and you wait until you can pay $60 for it, you have a $40 margin of safety. Now, you can be wrong about future growth, wrong about the economy, wrong about management's promises, and still make a profit.
Seth Klarman calls this simply buying dollars for 50 cents. But here is my big question. If this is so obvious, I mean, who wouldn't want to buy a dollar for 50 cents? Why doesn't everyone do it? Why do these opportunities even exist in the first place?
It's a fantastic question, and the answer is human nature. You have to understand, when a stock is selling for 50 cents on the dollar, it almost always looks terrible.
It's ugly. It has problems.
It has hair on it, as they say on Wall Street. The company just missed earnings badly. The CEO is being sued. The entire industry is supposedly being disrupted. It's J.I. Case in the middle of the Dust Bowl when nobody is buying tractors.
To buy it, you have to fight the crowd. You have to be willing to look stupid for a while.
And most professional investors, whose performance is judged quarterly, can't afford to look stupid. Their career risk is too high.
Ah, that's a huge point.
If you buy Amazon and it goes down, nobody blames you because everyone owns Amazon. The whole market went down, you say. But if you buy a struggling tractor company in a depression and it goes down even further, you get fired. So the institutional imperative, the need to stay with the herd, drives people away from the biggest margins of safety.
Let's pivot a little bit to a section of the book that I think gets ignored a lot today because it's not as sexy: bonds. A huge chunk of security analysis is dedicated to fixed income investing.
It's actually the foundation of the whole book. Graham started his career as a bond analyst, and the mental models he developed for analyzing bonds are, in some ways, even more rigorous than for stocks.
Howard Marks wrote the introduction to this section in the new edition, and he calls bond investing a negative art. I just love that phrase. Can you unpack that for us?
It's a brilliant way to put it. Think about the basic math of a bond. You lend a company $1,000. They promise to pay you, say, 5% interest every year and give you your $1,000 back in 10 years. What is the absolute best case scenario for you?
I get my 5% interest payments and my $1,000 back. That's it.
Right. Your upside is capped. You can't make more than that. But what is the worst case scenario?
The company goes bankrupt and I get zero, a total loss.
So the upside is small and fixed, and the downside is a 100% loss. Therefore, the job of a bond investor is not about finding winners. It is about excluding losers. The entire process is one of rejection, of finding reasons to say no.
That is a complete inversion of how most stock pickers think. They're always looking for the next apple, the 10-bagger.
They are. In stocks, you're looking for that one amazing winner that can make up for all your losers. In bonds, you're looking to avoid that one loser that can wipe out all your small gains. Mark says that in bond investing, winning is simply not losing.
So how did Graham go about analyzing bonds? What were his key filters for rejection?
He was absolutely ruthless. His first and most important rule was safety over yield. He argued that risk and yield are incommensurable.
Incommensurable, meaning you can't compare them on the same scale. You can't trade one for the other mathematically.
Exactly, meaning you can't truly be compensated for taking on a significant risk of losing your 100% principal by getting an extra 2% in interest. It's a fundamentally bad trade. He compared it to picking up pennies in front of a steamroller.
So if a bond looks risky, his advice isn't to demand a higher yield, it's just to walk away.
Just walk away. Or, if you like the business, buy the stock where you have unlimited upside. But don't buy the risky bond. Graham hated what he called second-grade bonds. He believed you should either buy high-grade bonds, which are super safe, or you should buy stocks. That middle ground was a trap for the unwary.
This leads directly to the insurance fallacy. I found this section fascinating because I see people doing this every single day with junk bond ETFs.
Oh, it's rampant. It's one of the most persistent fallacies in finance. The idea is that an individual investor can self-insure against default risk by buying a diversified basket of high-yield or junk bonds.
The logic being, well, sure, one or two might default, but the extra high interest rates on the 98 others will more than cover the losses.
Right. And that logic works perfectly for an insurance company insuring houses against fire, because houses catch fire randomly and independently. If my house burns down, it doesn't make it any more likely that your house across town will burn down. The risks are uncorrelated.
But business cycles and recessions aren't random.
Exactly. In a severe recession or a market crash, risky bonds don't fail randomly. They fail simultaneously. The default rate spikes across the entire asset class at the same time. So if you're holding a basket of junk bonds for that extra yield, when the economic storm finally hits, your diversification completely evaporates. You aren't insured. You are maximally exposed.
So Graham's advice for the average investor when it came to bonds was pretty stark then.
It was incredibly conservative. He basically said, unless you are a professional analyst able to do deep dives on debt coverage ratios and lend the structures and all that, you should just stick to U.S. government savings bonds. Full stop.
Or, and I found this interesting, he applies what he calls the depression basis for analysis.
Yes, this is his stress test. When you're analyzing a corporate bond, don't ask, can this company pay its interest now while the economy is booming? That's an easy test.
Right.
Ask, could this company still pay its interest if its earnings drop back to 1932 levels?
Wow. That is an incredibly harsh test.
It's a brutal test, and very few modern companies would pass it. But that's the entire point of a high-grade investment. It's designed to survive the worst-case plausible scenario.
Okay, let's move from the negative art of bonds to the more speculative, but also potentially more profitable world of common stocks. Graham divides investors into two distinct camps here, the defensive and the enterprising.
And this distinction is crucial. It's not about how smart you are or your IQ. It's about how much time and work you are willing to put in.
Let's start with the defensive investor. Who is that person?
That's the doctor, the lawyer, the successful shopkeeper. He or she has a good income and capital to invest, but their primary focus is their career. They don't have the time or the inclination to read dozens of annual reports. Their main goal is safety and freedom from bother.
So what's the strategy for them? Is it just index funds?
Index funds didn't exist then, but that's the modern equivalent. Graham's advice was simplicity itself. A 50-50 split between high-grade bonds and a diversified list of leading blue-chip companies. And he stressed that they should buy them via dollar-cost averaging over time, so they don't accidentally put all their money in at the top of a bubble.
So they shouldn't try to pick winners. They should just try to own a piece of the overall economy.
Exactly. Participate, don't speculate.
And the enterprising investor.
This is the active investor. This is the person who wants to beat the market averages. And Graham warns them, this isn't a hobby. This requires hard and systematic work.
And for this investor, this brings us right back to the balance sheet. In the modern world, we are completely obsessed with the income statement, earnings per share, revenue growth, profit margins. But Graham was a balance sheet guy through and through.
Bruce Greenwald, the famous professor at Columbia, makes a great point about this. In a stable, growing economic environment, earnings are what matter. But in 1934, in a chaos environment, assets mattered more. Graham's first question was always, if this business closes its doors tomorrow and sells everything, what do I own? What's the liquidating value?
We talked about the net-nets buying below that liquidating value, but Graham also had rules for earnings, even for these enterprising investors. He had a specific PE ratio limit.
He did. And this was for an investment, remember, distinct from a speculation. He said you should generally not pay more than 20 times average earnings for a stock.
And the key word there is average, not last year's earnings.
Yes, that's a critical distinction. Today, we look at trailing 12-month earnings, or even worse, we look at forward earnings, which are just Wall Street analysts' guesses about the future.
Right.
Graham said that's foolish. You have to look at the average earnings over the last 7 to 10 years.
Why the long-term average? What does that do?
It smooths out the business cycle. If a cyclical company had a massive blowout year because of a one-time event, the current PE ratio might look very low, very cheap. But if you average that great year with the previous 6 mediocre years, you get a much more realistic picture of the company's true sustainable earning power.
It's about normalizing. It's about not getting fooled by randomness.
It's about not being fooled by a temporary boom, and just as importantly, not being terrified by a temporary bust. If a good company's earnings are depressed for a year or two because of a recession, the long-term average shows you what the company's true potential is once things return to normal.
I want to challenge you on something here, because this is the big critique of the book. You mentioned net nets and buying companies for less than their cash value. That sounds amazing. But does that opportunity actually exist in 2026? If I open a stock screener app on my phone right now, am I going to find a JI case selling for $30 with $176 in cash?
In the U.S., large cap market. Almost certainly not. The market is just too efficient now. Too many computers and PhDs are scraping that data instantly. The obvious bargains are gone.
So is the book obsolete then? Is it just a historical curiosity?
The specific examples are obsolete. The underlying principles are not. They're timeless. You might not find net nets in the S&P 500, but you can find companies where the intangible assets like a brand, a user base, a patent portfolio are being dramatically mispriced by the market. You can find spin-offs where a big company dumps a small, unloved division, and for a while, nobody looks at it.
So the principle of price is less than value is always valid.
It's always valid. The places you have to hunt for it just shift over time as markets evolve.
Okay, so the specific math changes, but the human psychology remains the same. And that leads us to the most famous character in the entire book, the ultimate frenemy of the investor, Mr. Market.
Ah, Mr. Market. The greatest allegory in the history of finance. It's so simple and so profound.
Explain him for anyone who hasn't heard the story.
Okay, so imagine you own a small piece of a private business, and you have a business partner named Mr. Market. Every single day, without fail, he shows up at your office, and he offers to do one of two things. He'll either buy your share from you, or he'll sell you his share.
But there's a catch with this partner.
The catch is that Mr. Market is a manic depressive. He has severe emotional regulation problems. He's totally bipolar.
Sounds like the internet.
Exactly. Some days he wakes up feeling euphoric. He sees the future as bright and sunny and full of nothing but opportunity. And on those days, he names a wildly high price. I'll buy your share for $1,000. Other days, he reads a bad headline, gets terrified, and is convinced the world is ending. On those days, he offers to sell you his share for pennies on the dollar. Please, just take it. I'll sell you my share for $50.
Now, a rational business owner would look at the actual business results, the cash flow, the sales, and would completely ignore Mr. Market's mood swings.
Or even better, you'd exploit them. When he's manic and euphoric, you sell your shares to him at a ridiculous price. When he's depressed and terrified, you buy his shares from him for a ridiculously low price.
The key insight, and this is what Graham called the great illusion, is that Mr. Market is there to serve you, not to guide you.
Yes, but most people do the exact opposite. They let him guide them. They look at the daily stock price to tell them how the business is doing. If the price goes down, they think, oh no, something must be wrong. Mr. Market knows something I don't. I should sell. That is letting a manic depressive tell you what your house is worth.
David Abrams writes about this in his essay in the new edition. He draws a sharp line between market analysis and security analysis.
This is such a profound distinction. Market analysis is market timing. It's trying to predict what Mr. Market will do next week. Will his mood be happy or sad?
Which is basically impossible. It's fortune telling.
It's guessing.
Hmm.
And Abrams points out that in market analysis, there is no margin of safety. You are either right or you are wrong. If you bet the market goes up and it goes down, you lose money, period.
But in security analysis...
In security analysis, you ignore the timing. You don't care about Mr. Market's mood. You focus only on the relationship between price and underlying value. If you buy that $1 bill for 50 cents, you don't know when the market will finally agree with you and price it at $1. It might take a year. It might take 5 years.
But because you have that buffer, that margin of safety...
You can afford to wait.
Yeah.
You are protected by the value of the asset itself, not by your ability to predict the crowd's emotions.
So really, being a value investor is an act of supreme arrogance. It's the arrogance to stand up and say, the entire market with all its computers and experts is wrong about this price, and I, with my simple analysis, am right.
I might rephrase it as confidence based on thorough evidence. But yes, you have to be a contrarian. You have to be psychologically comfortable standing completely alone, sometimes for a very long time.
Which brings us to the man who stood alone and made billions doing exactly that, Warren Buffett. He wrote an essay that's included in the later editions of the book called The Super Investors of Graham and Doddsville.
This essay was basically Buffett's mic drop on the entire academic finance community. Back in the 80s, academics were pushing the efficient market hypothesis very hard. The idea that you can't consistently beat the market and anyone who does is just lucky, just a lucky coin flipper.
And Buffett said, okay, that's an interesting theory. Let's look at the coin flippers.
He presented a group of investors who all came from the same intellectual background. They either worked at or were heavily influenced by Graham's firm, Graham Newman Corp. Guys like Walter Schloss, Tom Knapp, Bill Ruane.
And did they all own the same stocks? Were they just copying each other?
No, that's the absolute key to his argument. They all operated independently. They were scattered across the country. They held completely different portfolios. One guy bought tiny, obscure companies. Another bought big, famous ones. The only thing they had in common was the Graham and Dodd philosophy.
They were all hunting for a margin of safety.
They were all buying dollars for 50 cents, just in different places. And the results.
They all crushed the market. Not for a year or two, but over decades.
Buffett's argument was simple. If we were all just random coin flippers, the statistical probability of all these guys from the same tiny intellectual village all happening to flip heads for 30 years is basically zero. It's impossible. It proved that value investing isn't luck. It's a superior framework for thinking about markets.
But Buffett also talks about the gene for value investing. He says you can't really teach this to everybody.
He does. He compares it to an inoculation. He says when you explain the simple concept of buy a dollar for 50 cents to a room full of business students, they either get it instantly in their bones or they never ever get it.
Why not? It seems so logical and simple.
Because it's not an intellectual problem. It's an emotional and temperamental one. Most people cannot handle the social pain of buying something that is unpopular and hated. They cannot handle the psychological pain of seeing a stock go down after they buy it, even if they know it's cheap. No amount of IQ points can fix a lack of emotional discipline.
We're coming towards the end here, and I want to zoom out. We've talked about the depression, we've talked about the math, the bonds, the stocks, we've talked about the psychology, but what is the ultimate legacy of this book today?
The legacy is that it professionalized the entire field of finance. It established the radical idea that shareholders are owners of a business, not just holders of a ticker symbol. Before Graham, management often treated shareholders as annoyances to be ignored. Graham fought for the idea that if you own stock, you own a piece of the company, and management works for you.
But is it a practical manual for today? If I go out and buy a copy of Security Analysis right now, will it help me beat the S&P 500 next year?
Probably not next year. That's the honest answer. In a roaring bull market, Graham's cautious methods often underperform. He's too conservative. He leaves money on the table because he's not willing to chase momentum.
He sells too early.
He sells when things get fairly priced, and then he has to watch them go to bubble prices. And that's psychologically painful. But over a full market cycle, over a lifetime of investing, it is the only strategy that comes with a built-in guarantee of survival.
It prevents the zero. It prevents the catastrophic loss.
It prevents the wipeout. And as the world learned from 1929, avoiding the wipeout is what matters most in the long run. If you lose 50% of your capital, you need a 100% gain just to get back to even. Graham's entire philosophy is designed to help you avoid ever digging that hole in the first place.
I want to leave our listener with a final thought, a provocative thought that came up for me when I was rereading the section on the distinction between the enterprising investor and the defensive investor.
Go for it.
The book implies, pretty strongly, that most of us are deluding ourselves. We think we are investors because we open an app on our phone and we buy a stock, but we haven't read the balance sheet, we haven't tried to calculate the liquidating value, we haven't looked at the 10-year average of earnings, we haven't done any of the work.
It's a harsh mirror to hold up, for sure.
So my question for everyone listening is this. If we aren't doing the work that Graham demands, the thorough analysis, are we actually investors? Or are we just speculators riding the coattails of a bull market hoping the music doesn't stop?
That is the uncomfortable question at the heart of the book. And Graham's answer would be very clear. If you aren't analyzing the security to ensure the safety of your principal, you are gambling. You might be winning for a while, but you are a gambler, not an investor.
And when the casino lights finally turn on,
You better hope you have your chips off the table.
on that cheery note, I think we'll wrap it up. This has been a deep dive into the absolute bedrock of modern finance.
Always good to check the foundation every once in a while.
Thanks for listening to the deep dive. Go check your portfolio and maybe look for that margin of safety. We'll see you next time.